none of this is necessarily exclusive to war, and that's what I always laugh when I always hear these pundits talking about, oh, this is happening, the markets are in turmoil because of the war. Short term, yes, but long term, fundamentals still win. The economy is still going. People are still going to the mall. Yes, we have war in Iran, and I don't want to downplay that by any means, but I'm going to a fish fry tonight. I'm going to spend some money.
Life is still going on.
I'm still living here in Louisville, Kentucky, far, far, far away on the other side of the world from Iran, right? So the economy is still moving. The economy is still pumping. Capitalism is still working. So I think the markets, at the end of the day, the longer this goes on, will act more and more independently from whatever is happening in the Middle East. The shorter amount of time that we're in this conflict, this war, whatever you want to call it, the quicker we will be to rebound from it.
Yep. What is it that is reported on the news? The old concept of if it bleeds, it leads. Well, okay, in the financial news, if it's negative, right? If an index or an individual stock that's, popularly owned goes way down, that's going to lead on the news because it makes you consume more news and therefore pay attention to the advertising and so on and so forth. So keep those things in mind when you're hearing all the negatives that are going on right now. Oh my gosh, the sky is falling kind of stuff.
Welcome back to another edition of the Retirement Planning Happy Hour with Eric Douglas, Chris Vaughn of Family Wealth Planning Partners, headquartered here in beautiful Louisville, Kentucky today. I can say beautiful because we do not have snow. We do not have clouds. We actually have this thing. I vaguely remember.
Disc.
Yes, something around sunshine, I think is what it's called.
Oh, finally.
So it's absolutely beautiful day here in the Bluegrass. It almost looks like spring has come back. This is what's affectionately referred to as, I think, first spring.
False spring,
first spring, whatever you want to call it. We're going to have probably 4 or 5 more of these. Yep. It's going to get cold again, and we're going to be miserable again. But as of today, it's gorgeous. And we're going to celebrate the beautiful day by enjoying a taste of a nice Green River Wheated. I'll let you go into that in just a moment. But before we do that, I figure we lead off with the topic as well for today, because we're going to go a little bit more timely today. We don't always do that.
Right, we don't. So I think it's important in this case, though.
In this case, when you talk about what's going on in the world and the headlines and what everyone's talking about right now, we are recording this on March 6th. So a week ago tomorrow.
March 6th, 2026.
I should be clear. Right. We're not that far behind in posting. Yes. But March 6th, 2026 is when we are actually recording this. So just keep that in mind as we are talking about what's happening with current events and what's happening in the world. But a week ago, we basically went to war. We invaded Iran. And so that has caused quite a bit of turmoil in the markets over the past week.
Yes, it has.
And so we figured the topic for today should be really, markets reacting to geopolitics, geopolitical events throughout the world. And in this case, most specifically, war in the Middle East. Not that there's never a war going on in the Middle East, right? There always seems that there's a war going on.
That way,
but more specifically, we have a war with Iran going on right now. So it's something that we should probably talk about, how that affects the markets, how that affects, investor sentiment and all that other good stuff. But with that, I will let you introduce the bourbon before we start talking about all that fun stuff.
Okay. So what we are drinking here is Green River Foolproof Wheated. This is a fairly new product that the bourbon world has been clamoring for a while. Green River is kind of a newer player. They're out of Owensboro. And I will tell you that the Green Rivers that I've had in the past are very hit and miss. I've had some that are really good. I've had others that are kind of right? But we all kind of figured that if they ever did this one, it would be good. And this is the talk of the bourbon world right now. I've talked to a couple of clients that are bourbon collectors that live in other parts of the country. They are absolutely going nuts trying to find it. It's not out there. Here in Louisville, where they tend to release this kind of stuff, it is becoming readily available. I walked into a big box store a couple of days ago, and they had a stack of cases of it. So very readily available. I've heard people say that this is a competitor for Weller Blue Label, which is the foolproof wheated Weller bourbon. I'd be interested in doing a side by side to see if I agree with that.
I would be
Keep in
very
mind,
interested in doing a side by side.
and that kind of tees up next week maybe. Weller Foolproof is a $67 bottle, but you're not going to find it for 67. You're going to find it for 100, 150. I've seen it for 250. That is typically because most of them that you see out there are barrel picks. It's a very, very sought after bottle. I will tell you that I would put a Weller Blue Label up against almost anything at any price. I mean, that stuff is fantastic. So now here comes something that sells for, are you ready? $45.
Is it really?
This is a $45 bottle we're drinking. So it's right in that sweet spot that you always like to go for. That supposedly is a competitor. So we'll find out. Is it really a competitor or is it a fraud?
Have you had this before?
I have, but I have not had this bottle. So we'll find out. And when I did have it before, I had it at an event where I'd already tasted 5 or 6 other things. So that kind of changes the palate. So it'll be interesting to see what we think of this one.
This is my first Green River. So
this is your first Green River of any kind, right?
Period of any kind, yes. So so we'll use that when we are discussing in a little bit more detail. So
I will tell you that this is by far, when I did try it, it was by far my favorite Green River that I'd ever had. But we'll see.
Well, very good. Well,
let's talk about current events.
Let's talk about war, right? Because that correlates, with money, right? I think I'm going to let you drive this one a little bit more because you were the one that kind of came up with most of the numbers this morning when I was in a couple of client meetings. And so I'll let you drive, some of the data and some of the conversation around the data, I should say. And I'll throw in my 2 pennies as needed because I will certainly have a few. But yeah, I'll go ahead and let you drive the ship today.
So the first thing what kind of drives this conversation in the first place, I can't speak for you, Eric, but I know I've had multiple times this week. I've actually had a fairly active calendar this week after we get off work. I've had several things going on, and I've had people ask me, so how is this going to affect the market? So what's going on? Are you all stressing? I've had a couple of clients say, hey, what's this going to do? And I think it's a couple of different questions. The first one is, how is this attack on Iran going to affect the markets in general? And then I think the second question is, how is it going to affect financial clients, and specifically ours in this case, but in general? So let's throw some statistics up first of all. Let's talk about what the markets have done. So I pulled the 3 major indices, so the Dow, the S&P, and the NASDAQ. And what I looked at was where they were at close of business on Friday last week as compared to about noon today when I was running these numbers. And everything is pretty volatile right now. So the numbers that we're going to read off are out of date 5 minutes after I wrote them down. So, all right. So let's, the first one that I want to look at is not one of the indices, but it's price of gas. That's what the average person out there is going to notice first. So the price at the pump, which that's the cost of fuel that most people actually associate with because they're putting it directly into their cars. As of this morning, the national average was $3.32 for regular unleaded.
And I will attest that there was definitely some sticker shock on my end because I had not been paying attention because I had a full gas tank a week ago. I had to fill up my tank yesterday, and there was definitely some sticker shock when I filled it up. It was like 311, 312, something like that when I filled it up yesterday.
Well, I have not filled my car up this week. It was actually done on Friday last week, but I'm going to have to probably on my way home today. And I've been kind of gearing up for this because I've seen it. So it was 332 as of this morning. Now that's national average.
Well, it was, just for context, about a week ago, it was about 275.
Right. So it's up
11.4%
in 1 week. A few cents, you may say, well, that's not a big deal, but 11.4%, when you put it in that context, you realize that's a huge jump
when you notice
in a very short period of time. Yeah, you're going to notice.
You're not always going to notice a 5-10 cent increase.
Right.
But when you notice, I noticed a 40-cent increase.
Right, exactly.
Right? So that's like, okay, you piqued my attention. You have my attention now.
You have my full attention.
And so now I'm going to start looking for gas prices again.
Right. And something I'll add to this, most people don't realize this. Modern vehicles are designed to go about 400 miles on a tank. So if you're, driving a very, very small four-cylinder car that doesn't weigh very much and it's designed for fuel economy, it's going to have a much smaller tank than the full-size pickup truck that, weighs huge amounts, and they're just not good on gas. So for the people who drive vehicles that are, let's just say, a little bit more thirsty, this is going to be more painful than the person who has a more fuel efficient car or doesn't drive that often. This does not affect my wife, for example, because she works from home, but it affects me because I drive about 35 miles one way, right? So everybody's going to feel that one a little bit differently. Okay, so let's look at the indices. All right, S&P 500. Now remember, on average, the S&P, which is the broader markets, is what we like to call that, is about 9.71% up per year. That's the average, right? So let's just kind of round that and call it 10%.
The historical average.
Correct, historically, right? It is down 1.63% in 1 week.
Mm-hmm.
If you extrapolate that out to the entire year, that is a horrifically bad year. That's a bad week. Okay.
Yep.
Keep going on. The Dow 30. Now we're talking about 30 companies. So this one's more, it's not as good of an indice as far as I'm concerned. Down 1.15. The NASDAQ, the tech heavy NASDAQ, they like to say, that's down 0.75. All of those, when you watch this every day, I'm sitting here going, man, those don't look as bad as what I was thinking. But then you take that number and you extrapolate it out and you go, those are bad. Those are really, really bad numbers.
Well, even just looking at the way that we've gotten to those numbers, this week specifically has been very much a seesaw, right? So we've had a really negative day, and then we'll have followed up with a really green day.
It was much worse than this earlier this week.
Mm-hmm.
You and I were talking about it on Monday. It was way down. And then I think it was Tuesday, all the markets, I won't say recovered all the way, but they were way up.
And then Wednesday they were down.
And then they went back down on Wednesday. Right.
Thursday they were up. Yep.
And we call that volatility. Mm-hmm. Right. So let's take that in context. Let's look at the exact same numbers over the last 1 year. I took these numbers back to March 6th of 2025. Right. National average for gas at the pump is up 21 cents over what it was last year. Okay. We were lower this time last year, up 7.2%. 7.2% over 1 year hurts, but it's not as painful as 11% in a week. Right.
Well, and the reason, looking at that 7.2% over the course of the past year, clearly that's all happened in the last week.
Yes, absolutely it has.
So the price was pretty stable for the past year.
Yep.
Right, at the pump, and all of that has changed, and we've had extreme volatility. Not really volatility. The price of the pump has just gone way up in the last week.
Yes, it's pretty much all happened this week.
Yep.
Okay, so now let's look at those three indices. Now, the S&P, we said this week is down 1.65, or excuse me, 1.63, but that includes, or that is included in, over the last year, it's up 17.71%.
Mm-hmm.
So that tells me this is not as painful as you might think. Remember, historically, the 1 year average is 9.7, right? So the Dow is up 11.11, whereas this week it's down 1.15. The NASDAQ is up 24.78, whereas this week it's down 0.75. So, take those numbers with a grain of salt. When you look at those averages over a year, you look at these big numbers that we've got, but we've had good days and we've had bad days in that window. And I think people have a tendency to forget that. Mm-hmm. We've had good weeks and bad weeks. So just kind of take it with a grain of salt when you see these numbers dropping off quickly. And now we're going to talk about how war actually affects those numbers.
Well, before we do that, I want to highlight one thing real quick. And this has absolutely nothing to do with war. This has everything to do with markets in general, right? Because so often we hear, what are markets doing? We get the question, well, how do you feel about the markets? What are markets doing? Oh, the market's up, the market's down. This is actually a very good representation of what market.
Mm-hmm.
What do we mean by market?
Okay.
Right? And I would even add, these aren't even necessarily the best barometers of the market as a whole, right? And that's going to be more, the Russell index, right? But if you look at the S&P 500, it's up 17.7 over the last year. The Dow's up 11. NASDAQ's up 24. Those are three radically different numbers.
Yep.
Those are three dramatically different indices that have the components within each one of those indices are quite a bit different. So when you say what's the market doing, this is a very easy way to say what market.
Yeah, correct.
Right? Because the market is just not one of these single indices. And even within the market itself, we have multiple different things going on, right? Different sides of the market can react differently in all kinds of market conditions. And even just in the last, couple of weeks, what's been happening with the price of oil? What's been happening with oil stocks?
Well,
Energy stocks.
so oil in general has gone way up. And in fact, as of this morning, it was last I looked, it was about $88 a barrel for crude oil.
So the S&P 500 is down 1.63 over the past week, but those same oil stocks, which are some of the components within the S&P 500, are up
way up. That's right.
Exactly, right? So the market is not one single stagnant thing, and this is a pretty good representation, I think, of all the different components of the market and how they don't always correlate with one another directly.
I think that's a good point, and it kind of leads into something that we've talked about many, many times. What is it that is reported on the news? The old concept of if it bleeds, it leads. Well, okay, in the financial news, if it's negative, right? If an index or an individual stock that's, popularly owned goes way down, that's going to lead on the news because it makes you consume more news and therefore pay attention to the advertising and so on and so forth. So keep those things in mind when you're hearing all the negatives that are going on right now. Oh my gosh, the sky is falling kind of stuff. And okay, that leads us into, let's look at what historically has happened when the United States specifically has gotten into some type of major military conflict. Okay, so I did a little research on this, and it was basically, I went back 100 years. So World War I is not part of this equation. It was basically World War II and forward. And I looked at several different things. So World War II, Korea, Vietnam, the Gulf War, which we call it the Gulf War now. When it was going on, we called it Desert Storm.
Yeah.
Right. The war in Afghanistan, which we are measuring from 2001 to 2021, and then the Iraq War. A lot of people kind of conflate those as being the same. The Iraq War is 2003 to 2011. In every case, they showed short-term volatility and long-term stability of an upward trend, right? So let's kind of go into those. I did find an article. It was in the Times of London that was written this week, and it specifically talked about when you look at major crashes, and I think that's what people are worried about. Oh my gosh, we have attacked Iran. The markets are going to crash. That's not what causes crashes. So the article that I read was talking about how the crashes, not the volatility, but the crashes where the market goes down and it stays down for a period of time, and a big number.
Extended bear market.
Extended, yes, bear market. Thank you. Financial bubbles and recessions, not wars. Wars are not a driver of those type of bear markets, those long-term big downturns in the market, right? So let's give some examples of that specifically. There was a statistic we were looking at, and these are kind of all over the place. It depends on the time frame that you gauge. But if you look back during World War II, over the period of time that we were in World War II, and this is specific to the S&P, that's the broader market most people would consider. The markets were up, depending on how you gauge it. The S&P 500 did not exist at that point in time. So if you used a proxy, you're looking at 60 to 80% up over the window of time that we were involved in World War II.
Yeah, and the difference is, the reason why there's not an exact number is because we don't really have a specific this date to that date.
Correct.
Right? As far as when the war began and when the war ended, and what are we counting as the U.S. is involved?
Right. Is it Pearl Harbor until VJ Day, or was it when we started helping out with the Lend-Lease Act or all that stuff? That's where there's some vagaries here. Yeah. Korea, a much shorter conflict. But the markets were up 35 to 45% in that same window. Vietnam, interestingly, was fairly flat during the time frame of Vietnam. But remember what was going on in the economy outside of Vietnam.
Yes.
You had a lot of turmoil. You had a lot of interest rate issues. You had, gas crisis going on, stuff like that were not necessarily related to the war. The Gulf War. Okay, remember, of the ones that we're talking about, the Gulf War is by far the shortest. That kind of started in August 1990, and we got involved a couple days later. But the actual fighting war only lasted a couple of weeks, right?
Yeah.
And during that window of time, the markets were up 20 to 30%. The Afghanistan war, okay, that's a 20-year long war. That's the longest war that the US has ever been involved in. Markets were up over 80%. The Iraq war, about a 10-year period of time, 40 to 50%. And remember, during that one, you had 2008. That's when you had the true crash of the markets that was not related to what was going on in Iraq at the time. The point here is every one of these major wars that we were involved in over the last century, every one of them, the market, with the exception of Vietnam, I'm sorry, every one of them, the markets were positive, and it was a healthy positive during those time frames. It was not a major market crash that stayed on.
And I think what's interesting too to note that broad U.S. equities historically produce these positive returns during most wars, which obviously you just went through, but this doesn't happen in a vacuum,
right?
Either, right? So to your point, most of the negative performance of the S&P or the market in general is a result of recessions and bubbles bursting and things like that. It has nothing to do with war. So just take, for instance, what struck me was when you look at that, the performance of the market during the Afghanistan war, and we had the Afghanistan war starting. I'm sorry, the Afghanistan war starting in 2001, the Iraq war starting in 2003.
Right.
What else was going on in the early 2000s? What had just happened when we went into war with Iraq?
A series of things. You had the dot-com bubble burst.
Correct.
Right. So that was all the positive of the 90s. We had to pay the piper for that.
So the early 2000s were.
And then you had 9/11 on top of that, which, I mean, either one of those would have been a major problem in the markets. And you had those basically in back-to-back years.
So to the point of nothing happening in a vacuum, the markets were pretty relatively depressed, I would say.
Correct.
We had already had kind of the bubbles bursting. We had already been in recessions, right? We were kind of at the bottom of a recession when we went into war in the Middle East with Iraq and Afghanistan. So when you look at the performance of the stock market during that time period, you can say, well, we kind of started at a low, so to speak, right?
Yeah.
As far as from the stock market performance. So none of this is necessarily exclusive to war. And that's what I always laugh when I always hear these pundits talking about, oh, this is happening, the markets are in turmoil because of the war. Well, short term, yes, but long term fundamentals still win. The economy is still going. People are still going to the mall. Yes, we have war in Iran, and I don't want to downplay that by any means, but I'm going to a fish fry tonight. I'm going to spend some money.
Life is still going on, isn't it?
I'm still living here in Louisville, Kentucky, far, far, far away on the other side of the world from Iran, right? So the economy is still moving. The economy is still pumping. Capitalism is still working. So I think the markets, at the end of the day, the longer this goes on, will act more and more independently from whatever is happening in the Middle East. And it's probably safe to assume that the shorter that this, the shorter amount of time that we're in this conflict, this war, whatever you want to call it, the quicker we will be to rebound from it.
Yep.
So
and therein lies an interesting point of the major data points that we've got here. It's got 6 different wars, and only one of them was a fairly short-lived. All of these are multiple year wars, except for Gulf War, or the first Gulf War, or Desert Storm, whatever you want to call it. That one, start to finish, was less than a year, and that includes the buildup and everything else. The Desert Shield, if you remember that part.
That's a term I haven't heard in a long time. Yeah.
I was very much on active duty when that happened, so that was part of my life. But I tried to think, okay, so what else has gone on that would be good short-termers? Because everybody that I've talked to agrees this is going to be a short-term war that we're dealing with right now. I certainly pray that that's true.
That's certainly
I thought, okay, so just going back through my mind and thinking of ones. Okay, well, let's see. We had Grenada, if you remember that one. We had Panama. Somalia lasted for a few years, but that's a little bit of an outlier, right? I couldn't come up with anything else that was short term that's kind of compared to what we're dealing with now, other than the Gulf War. So kind of difficult to look at the way that that one is going to impact the markets versus the other ones. And to your point, none of these happened in a vacuum, right? Speaking of which, there's another statistic that we came up with about the market patterns around the outbreaks. So what I did a search for here is what happened in the 3 months prior to a war and what happened in the 3 months after a war, specifically to the S&P. All right, World War II, the 3 months before, the markets were down 12.3%. Keep in mind, we're still in the Great Depression at that point in time. Keep in mind that, before Pearl Harbor, we didn't know how this was going to play out. We knew something was going to happen. We just didn't know how it was going to play out. And in the 3 months after, VJ Day, when the war actually ended, the markets went down 9% in those 3 months. Well, why did they? Okay, let's go back to your point. Nothing happens in a bubble. What happened in the 3 months, or for that matter, just the period of time immediately after World War II? This entire country had changed the way that it produced everything.
The Industrial Revolution.
Right. It was very much an industrial revolution. This is when Rosie went to work in the factories. This is when people rationed. This is when little kids were going out and finding things that could be recycled. Right. And I've heard one story after another, I'm sure you have as well, from the people who lived through this era. All of a sudden, the war is over, and we've got to convert our industry from a wartime industry to a peacetime industry. That's expensive. The companies are going to be shelling out a lot of money to do that, to rework their factories. People are returning from war and going back. People who were in the factories are now going back into the homes. All the things that happened there, you would expect a downturn in the market, right? But look at the other ones. Before Korea, up 0.6. After Korea, up 10.3. And I think that was probably because people were glad it was over, right? Vietnam, down 1.5. That was another one that I think people were tired of war, right? There's a lot of people who fought in Vietnam that had also fought in World War II and in Korea. Certainly people lived through it. When it was over, now this is where I could not find the data on this one, is that when our involvement ended in 1973, or is that in 1975 when we left the embassy in Saigon? I don't know. But it did go up because people were glad it was over. The Gulf War is a really interesting one. In the 3 months before the Gulf War, which started in January, the markets were up 9.8%. But in 1990, they took a huge hit when Iraq invaded Kuwait. We didn't know what was going to happen. That leads into another talking point that we're going to have. But the point here, and by the way, the Iraq War, we were down. Remember, before Iraq was in 2003, you had 3 back-to-back-to-back bad years in the market in 2000, 2001, 2002. But when the Iraq War ended in 2011, the market was up 13.6. Back to that vacuum question. In 2011, what were we going through?
Well, we were still recovering.
We were recovering from 2008. Exactly. Yeah. So that's kind of the point. There was a timeline pattern that I found. Pre-war uncertainty equals market dips. War begins, creates sharp volatility. 3 to 6 months afterwards, the markets rebound. And on larger conflicts, the economy adapts over time to the reality that this is going to go on for a while, right?
I think that's the takeaway, right? Markets often fall before the conflict begins and recover once uncertainty is reduced. What phase are we in right now?
We're in the uncertainty phase.
Exactly. Right? Things are very uncertain because we just got into this conflict. Right. We don't know how it's going to be resolved. We kind of we assume that this will not last too terribly long, but we don't know that for a fact. So what's been happening in the markets in the last week? Extreme volatility, to your point. War begins, we have sharp volatility. Volatility doesn't mean everything drops like a rock, by the way.
Right.
Volatility is up and down, right?
Exactly
and so we've had extreme down days and we've had extreme up days all in 1 week. Every day this week has just been a roller coaster.
Yep.
Okay. because we don't know how to react. And, we react one way, and then the next day we overreact to our overreaction, right? So it's up and down, and no one knows, what's going to happen, and no one knows how to really play this going forward. Because everyone's trying to find an edge, and the markets are trying to figure out who's going to be the winner and who's going to be the winners and the losers in this whole scenario, right? And we just don't know the answers to those questions right now. Hence the extreme volatility. I would imagine, and I'm going to say hopefully, because hopefully by the time this thing airs, we're pretty much out of it. Right?
Exactly. That would be the ideal scenario.
But, hopefully within the next few weeks, we're going to have much more of a resolution around what's going on in the Middle East, what's going on specifically, obviously, in Iran. And I would expect a leveling out of the market at that point, and hopefully maybe even a little bit of a rebound, right?
Yeah.
I think what's interesting, too, is when you go back to last year, right around this time last year, what were we talking about very, very heavily?
Well, right about this time last year, we had a brand new president. We were talking about tariffs and everything else that went on at the beginning of this term.
So that's going to lead into I'm going to juxtapose this year with last year, because I see a lot of similarities with what happened last year around this time. New president, markets were hovering around all-time highs a year ago.
Right.
We have a president coming in trying to change economic policy. We're constantly talking about tariffs. Nobody knew what a tariff was, and then all of a sudden, we're all experts on tariffs, right? We did a couple podcast episodes on it.
Yes, we did.
And we basically talked about how markets traditionally have not reacted at all to tariffs. The economy keeps moving forward, and I remember doing those episodes, and I remember a lot of those conversations with clients. But all that to say, I think tariffs were nothing more than a catalyst in the market. I think the market was hovering at all-time highs. Everyone's been worried about this kind of AI bubble, and can the market continue to sustain this growth, and can it keep going up and up and up forever? And the tariffs were a catalyst, or almost like an excuse for people to maybe sell out, kind of capture some gains in their portfolios, sell out, move some money around. It was a catalyst to, the markets having some volatility. It was like, everything was fine, but under the surface, things weren't necessarily fine. There was a lot of anxiety around the markets. Fast forward to a year later, we got through the whole tariff situation. The market rebounded completely from the tariff issue. Well, there wasn't even really a tariff issue, to be perfectly honest, at least not as it relates to the markets and investments, right? So a year later, we're kind of in the same scenario. Markets are kind of hovering around all-time highs. We have this whole AI thing that's happening in the background. Everyone thinks the markets are in a bubble. We have this K-shaped economy. There's all of these talking points that are going on in the market right now, and everyone's it's weird because the markets are at all-time highs, yet no one really feels great about them.
Right.
That's exactly where we were a year ago. And so now this thing with Iran pops up. It's a catalyst. It's an excuse now for people to take some money off of the table, right?
Right.
It's an excuse to go ahead and sell. And no one really knows, like, oh, is this it? Is this what's going to cause the markets to crater? Is this finally, because we've been talking about the markets crashing for years now. Well, if you watch TV anyway, if you watch Fox Business and CNBC, there's always a reason why the markets are going to crash. And we've talked about that before. But I think right now we're in this position where, because I think at the end of the day, this Iran thing, okay, there are real people involved, and I'm certainly not downplaying it, but I think at the end of the day, this is going to be mostly a nothing burger as it relates to the United States economy. And we're going to roll right through this, but I think right now it's a catalyst that is providing fear and anxiety in the market and causing a sell-off, and causing this extreme volatility because we're not totally sure what direction we're supposed to play this.
There's an interesting concept. If you go back and you read any of the stuff about Warren Buffett and the way that he always invests, there's a concept about how individual companies are logical. There's a board of directors and a leadership management team that are making decisions for that company based on what they believe is in that company's best interest. You buy that stock in part because you think they got good leadership and they're going to make the company more valuable, and therefore your stock's more valuable. But when you look at the markets as a whole, there's nothing logical to it. It's emotion. The markets as a whole react based on completely upon emotion, and that kind of comes back to what we were talking about. What's going to happen? I don't know. What was going to happen after 2008? I don't know. We can go back and we can look at the wars, we can look at the recessions, all of that. We didn't know what was going to happen. And because of that, when you've got something that's driven by emotion, things tend to go sideways. They get volatile. We did a podcast on what do we think is going to happen in the market this year. It's a midterm election year. Why are midterm election years volatile years? To go back to your bubble comment, because we don't know what's going to happen. Why are the years after midterms and election years tend to be good years in the market? Because we know what's going to happen, right? We know who's going to be in charge, and therefore we know the kind of rules that we're going to be playing with. So that goes back to that volatility thing, is the fact that the markets are emotion. And that's why you don't buy the market. You put together good portfolios and you don't chase things.
And I'm even going to go back to kind of the beginning where we were talking about the performance of the indices, right?
Mm-hmm.
What's interesting to me is the NASDAQ is down the least.
Right.
And NASDAQ's very
tech heavy,
right? It's almost like technology, because technology companies typically have the highest profit margins. They're going to be a little bit more immune from what's going on overseas. It's almost like that's the safe haven this week.
That's just an amazing thought, isn't it?
Yeah, and by no means I'm not trying to extrapolate that for all market
no,
conditions,
please don't.
Right? But it's interesting to me that the NASDAQ is down less than half as much as the S&P 500. The S&P 500 is down more than double what the NASDAQ is over the last week. And so I just find that very interesting, that tech, that growth, and more specifically tech, has kind of been the safe haven in the last week. Now, it had come down a little bit more prior to, once again, nothing happens in a bubble, right? Nothing happened. So, but the NASDAQ was already down a little bit more than the S&P 500 over the last several months prior to this last week. But even still, you would think maybe with the market volatility that people would sell out of their quote unquote riskier investments, riskier positions. And that has not been the case.
So we've been talking about, and we can keep going on about the, I had a client, or actually, I'm sorry, not a client, a friend of mine actually texted me earlier this week and he said, why are people selling equities and buying oil? I didn't respond to him with, an explanation. I responded to him. I literally sent an icon that was the Iran flag. I bumped into him last night at an event and he goes, yeah, that's exactly what it was. Once again, it's that volatility. It's not knowing what's going to happen. Okay, so let's kind of change gears a little bit. The first question was, how does this particular war, or wars in general, or volatility that is created by them, how does it affect the markets? Okay, now let's change that. How does that affect clients? Because I think that is a uniquely different question and answer than how it affects the broader markets. The first thing that I would talk about is, Joe average client out there is not invested in the market. Their money is in securities. It's in stocks, bonds, mutual funds, ETFs, any number of different things. But the typical person out there is not just in an S&P 500 ETF, and that's it. Yeah. That's not normal.
And if you are, please give us a call.
Yeah, please. We have a different conversation there. You know what? I've had multiple meetings this week with clients that are already retired. And because they're already retired, or if you were close to retirement, this would be the same type of situation. We're looking at the monies that are coming out of their accounts for the purpose of creating income flow, right? And because of that, because I'm having these meetings, I'm reviewing, exactly what's going on. Is everything doing the way we designed it to? I haven't had a single person that was upset about what was happening to their money. And the reason for that is the monies that they are living on are not invested in the broad market. Mm-hmm. They're in something that's designed to be as little volatility as possible. This is actually the great example. I'm sure you've had this conversation with your retired clients. Well, why is my portfolio not keeping up with the market? And you have to have that reminder, because you're living off of it. We don't want to run those kind of risks. And now is when it pays off. When the market does go sideways for a week, a month, whatever, the retiree's portfolio should not be going sideways with it. It should be nice and stable, when you're going through these kind of things.
And those conversations are completely different right now.
Yes, they are.
Had a little bit of volatility in the market, and really year to date, with some the S&P 500's down obviously a little bit year to date so far. But boring, vanilla, diversified portfolios are doing just fine.
Yes, they are.
So, and I was actually talking about that in a client meeting this morning, as a matter of fact, where the sexiest portfolios tend to be very boring.
Yeah. You know what? That's a good way to phrase that. The boring, I was going to say the boring portfolios, they don't grab your attention. I don't want it to grab your attention. I want your money to show up month in and month out.
Yeah.
And I want you to go live your life and not be worried about, oh my goodness, Trump did such and such. Does that change my plans? No, not if you've got a good income plan built. It doesn't have any impact on you at all, nor did the previous president or the one before him, right? And that's kind of the point. The question is, how does what's going on with the current war or anything to come in the future, how does that have an impact on clients and their money? If the portfolios that are used are built properly, it shouldn't have much of an impact at all in the short term.
It's weird how every one of these podcasts ends the same way.
Yes,
with the same ideas and the same recommendations. It all comes back to planning.
Yes,
it's super vanilla. It's super boring. It's super predictable. But planning. It's all about income planning and retirement, and it's all about setting up your investments to support your income plan. And then you mentioned doing life, right? And doing life on purpose. And now that we have our new signage up finally behind us,
that's right.
We've been going through this branding, and everything is about doing life on purpose.
Right.
That's kind of our new tagline, and going through the planning process to help you be able to do your life, to live your life according to what it is that you want to accomplish and what makes you happy. So you don't have to constantly watch the volatility in your portfolio. You don't have to worry about the headlines that you see on CNBC and Fox Business and any other news station that you want to watch. You don't care. You can tune out a lot of that noise, because if you've done the proper planning, your portfolio is in a position where it's going to be relatively guarded from what's happening in the world today based on current events.
You're not affected by this or any number of other things that could go on, and certainly will again in the future. That's the whole point of planning, of having a good plan. And by the way, I had this conversation with a client last week. They are coming on board right now. They have been with the same advisor for over 30 years, right? They have been pushed from one new physical person advisor to another as people have retired, but they're with the same company. And then they're in the old school 4%. That's not a plan, right? That's a withdrawal strategy. And right now, they are panicked because of what we've been sitting here talking about. They've been told we might need to back off a little bit. That's why they're coming on board with us, because you got to quit doing that. That's not a plan. A good plan, to your point, you shouldn't be worried about what's going on in the news. You're watching the news because you're curious, not because you're terrified.
Yep.
Okay.
Can we talk about how good that signage looks behind us, by the way?
It does look pretty good.
We don't have a blank wall anymore.
Yeah.
We're a little bit more settled into our new office digs.
We're getting there. We've got there's more signage going up today. We have a couple more steps that are going to be done, and then we're going to do that video that you've been teasing for several weeks now, where we'll give everybody a tour of the office and let you know what it looks like when you come in to see us.
We definitely need to do that. But anything to wrap up our conversation today before we get into bourbon reviews and what's really important today?
I was going to say the most important thing is the fact that both of us have put more in our glass. That's a little precursor of what we're about to talk about.
That's probably
I think the big thing here is, remember that, and I don't want to downplay the risk that some people are going through right now. If you keep it completely focused on the markets in general, first of all, the markets will always do what are in their own best interest, those individual companies. And that's why long term, they're always a good play. There's going to be volatility. I go back to that example of, or the analogy, I'm sorry, of the mountain climber who's climbing the mountain. Yeah. And by the way, he's got a yo-yo in his hand. If you're watching the yo-yo, you're going to be sick to your stomach because it's constant ups and downs. If you watch the mountain climber, he's going up for the most part, but occasionally he's got to go down to get to the next step. And sometimes it's a sharp down. But if you step back and you look at the mountain, it's
Mhm.
going up. And that's why this is a long-term plan. If you have a long-term time frame before you use your money, this is going to be a blip. Even if this were to go on for a long time, God forbid, it's still a blip in the overall
Mhm.
thing. If you are at or nearing retirement, your portfolio should be built where this doesn't have an impact on it at all, so that you can continue doing your life however it is that's really the story here. Is this should not be impacting you. So be concerned as a citizen, be concerned as somebody who loves our country. Don't be concerned because of what the markets are going to do and how that affects you if you got a good plan.
So Green River, weeded,
I'm going to assume
foolproof.
that you really like this because
Well, I like
you
it even.
tore that up.
Well, I like weeded.
Yes,
I like
yeah,
weeded bourbons anyway, right?
I do too.
You know that. Yes. So you talked about the new blue label. I'm not going to go that far yet. I would love to do a side by side,
But I think a side by side is going to happen.
but I will tell you, you said it was $45 a bottle.
That's extremely attractive. Right?
I can pretty much guarantee the next time I'm in a liquor store, I would be looking for this bottle.
Yeah.
If it's $45-$50, that will be in my regular rotation. This is delicious.
So I want to point something out. This is a foolproof. Okay, so we were talking about the Weller Blue Label, which is a foolproof.
Mm-hmm.
Cask strength and foolproof are not the same thing. This is 109.
109,
proof.
yeah.
So
109.3.
If you're not a bourbon person, 109 proof might sound like it's through the roof. It's not, right?
No. I mean, there's a little bit of a bite, but it's not much.
It's a pleasant bite, though, isn't it?
It's very nice. It's mild.
Cask strength means when they took it out of the barrel, this is what the proof was on it when they took it out.
Yeah.
Full proof means this is what it went into the barrel as.
Mm-hmm.
And as there's evaporation and aging goes on, the proof goes up, and then they cut this to get it back to the full proof that it was at barrel entry.
Yep.
Right. So I will tell you that when you barrel at a lower proof, you don't get as good of a yield, which is why most companies barrel at about 125 proof, right? And then they cut it down to 100 or 90 or whatever you want. The ones that go in at a lower proof tend to have a lot more flavor, and this is no exception to that.
So the nose on this is one of the strongest.
The nose feels like it's going to jump out and get you.
So when we opened up that bottle before we filmed and you walked in, you could smell it.
The whole room,
absolutely. In the room, and now that that's a strong nose right there. That might be the strongest nose.
Yeah, I've had stronger, but they are really high proof stuff that's stronger than that on the nose.
Well, let me add, it's very pleasant.
Yes.
So it's not overbearing by any means. So normally when you think of a very strong nose on a bourbon, you're thinking, to your point, really high proof, really strong, a lot of bite. That's not the case here. It's I don't know better. It's delightful.
Oh, good word. I like that.
It's delightful.
This is a delightful bourbon.
It is very good. It's complex, but it's
okay. So if you've got the palate for it and you really dig into this, there's a lot going on here. But there's some overwhelming flavors, and they're the traditional bourbon flavors: the oak, the caramel, a little bit of vanilla to it. There's a spicy bite, which you normally don't get in a wheated bourbon. And that's from the higher proof.
It is spicier than most wheateds, yes.
Oh my gosh, this is fantastic. At $45, I'm going to be real honest with you. I'm thinking next week we're going to have to do another side by side. I think we're going to have to put a Weller Blue Label up against this. It needs to get the opportunity to defend itself. But I can tell you this.
I mean, not that it needs to, because
if you're spending $150, $200, $250 on a bottle of Weller Blue, and you're spending $45 on this, I will take this 7 days a week and twice on Sunday. Now, if you're spending retail for a Weller Blue, which I have a couple bottles that I bought at retail, and I'll bring one of those in and we'll try that. That might change it a little bit. Is this good enough to dethrone a king? I don't know. We'll find out. But I will tell you, at $45, this is one of the best bourbons I've ever had at that price. This is outstanding.
All the aftertaste, the roof of my mouth, but it's easy going down. There's no bite going down.
There's nothing about this I don't like.
It's
fantastic.
It's an easy drinker, but it's got a lot of flavor. This is really good.
I did, while you were talking, I did put 1 drop of water in a smaller amount. Don't do that.
I haven't done
it. It did not help in any way. Yeah. Just drink this. If I was going to do anything to this, I would consider, because this was sitting in my office overnight and it was a little bit warm in my office this morning, I would consider maybe throwing it in the refrigerator for 20 minutes before you open it, just to put a little chill on it. I think that might be good, but I don't want ice or water in this. It tastes way too good exactly as it is.
Cool horseshoe bottle too.
This is a Green River thing. There's a horseshoe on the bottom. This is a very Kentucky thing for those people who are not from this area. The Green River is very much a river right here in Kentucky. So,
this is my first Green River. This is fantastic.
Wow. Well done.
Now you say it's your favorite, so maybe I shouldn't try another Green River.
Why would you want to try a different one? No, it's nowhere but downhill from this one.
But I can guarantee you, next time I'm in the liquor store, I'm going to be looking for this, and I'll probably bring up one.
Just remember, they have a full proof and they have a weeded. This is the full proof weeded.
Yeah.
So, on another note,
we probably should not even be doing this episode, to be perfectly honest with you, because now I'm afraid more people find out about this. And
that's true. This is horrible stuff. You do not ever want to buy it, right?
This is at $45-$50, this will be a regular.
This is now, my understanding is this is something that they are going to be producing a lot of. So in theory, once it starts coming out, you're going to see it. I was looking for this one for quite some time. I couldn't find it.
Really?
I actually bought this particular bottle. I bought in Calvert City, Kentucky, which I've got a little place down there when I'm driving down to Murray with the kids for school.
You stopped in Calvert?
I was in Calvert City this weekend.
Did you realize I have family in Calvert?
Yeah. We've talked about that one. I stopped down there. Well, you need to tell them this place. I'll give it to you off camera. We've tasted stuff that I've bought down there before. But I was down there last Saturday. My son had a scholarship application that he had to do an audition for. And while we were down there, I stopped in and they had this, and I was like, man, I've been looking for this, and they had it at retail. And since then, it has exploded. It's almost like all the shipments hit this week. So if you're in Louisville, big box stores, you're going to find it. The little small mom and pops, you might be able to get it already. If you're outside of Louisville, be patient. I promise it's coming, and you're not going to be disappointed in waiting for this one. This is a reward.
Well, if you got off the Calvert City, Kentucky exit, you were less than 5 minutes from my grandmother.
Well, then I will tell you where this little hiding place is of mine, and they can go down and pick some stuff up.
So, good deal. Well,
so let's wrap it up.
Yeah, this is a good one. So we will finish our drinks here after we turn the camera off. Thank you very much for joining us. If anything that we said today resonates with you and you would like to have a deeper conversation, please go to the show notes, go to our website, give us a call, schedule on the line right there in the upper right-hand corner of our website. We would love to chat with you. If anything in here resonates with someone maybe that could listen to the topic and might have some thoughts or some opinions or maybe just need some help, please forward this episode on to them as well. We would greatly appreciate that. Thanks for listening. Thanks for sharing. See you next time.